special coverage of the Credit Suisse Asia Investor Conference from Hong Kong. And joining me now is a very special guest, someone who's been widely tracked by the Indian audience. Yes, Sakthi Siva, Asia Pacific Strategist at Credit Suisse. Sakthi, thank you very much for joining us. I don't know how much you know, but there is a huge fan following for your calls, as far as EMs and as far as India is concerned.
Thank you.
First question, which probably even your investors have been asking you of late, why underweight India?
Okay. Our theme for the region is actually the best ROE fundamentals in 6 years.
Correct.
And India actually does have improving ROE. So we are constructive on India from an ROE perspective. But the reason for our caution and the reason for our underweight in India is we think a lot of this is already priced in.
Okay.
So if you look at India, ROE has actually risen by about 1 to 2 percentage points from the low. And that's, as I said, our theme for the year. But unfortunately, what we think is already being priced in is something like a 19% recovery in ROE.
Okay.
So I want to emphasize, it's really a valuation call.
Okay.
So it's not that we don't agree with the ROE improvement and whatever else.
Sure.
It is very much a valuation call.
Okay. So while everybody debates that valuation for India at 17, 18 times forward earnings looks expensive, but the flip side to this is there is an argument that the earnings are going to pick up in the second half of this financial year. Is that something which you are of doubt that earnings will not actually come up for India?
Actually, we actually think earnings will improve.
Okay.
But our argument is actually earnings are improving across the region as well.
Sure.
Right? And there are markets that are not pricing in as much of an improvement in earnings.
Okay.
So if we look at the Asia Pacific region as a whole, the consensus is now picked up to about 15% earnings growth for the region.
Sure.
Right? Remember, for the last 3 years, earnings have only averaged around 2%.
Correct.
So 15 is a huge improvement. And the last time we had double-digit earnings growth was back in 2010. So again, it's not that we are not positive on Indian earnings.
Okay.
It's just that we think that a lot of other markets are also seeing improvement in earnings.
Sure.
So India's ROE is rising, but so is Korea's ROE.
Okay.
So is ROE in Australia, Taiwan, and even if we look at MSCI China, if you exclude the financials, ROE is also starting to pick up.
Okay. So the big sector call or the big call that I read in a report of late is that you are looking to advise clients to buy the cyclicals, especially in Asia. What's the view there, and probably what are the key themes that you think investors should look at?
Yeah, we're still keen on cyclicals. A lot of clients have been worried that the rally in the cyclicals has been quite a lot, has been quite large. Cyclicals have outperformed defensives by over 20% over the last 18 months. So some clients are saying maybe there's a lot of optimism about Trump and his policies already being baked into the cyclical prices. Our argument is that if you feel the cyclicals have run hard, instead of buying defensives, maybe look at a switch from some of the North Asian cyclicals, which have done particularly well, towards some of the ASEAN cyclicals, which have actually been kind of laggards. So if you look at North Asia, cyclicals have actually outperformed defensives by as much as 35%.
Okay.
In ASEAN, the outperformance is only around 10%.
Okay.
So in December last year, one of the big changes we did was to take a little bit of what we call profits in some of the tech stocks. We're still overweight, but we took a bit of profits in some of the North Asian tech stocks. And we've actually been adding some ASEAN cyclicals, which haven't done at least as well as the North Asian ones.
Okay. A word on the Trump policies and the global markets, because last year we saw two unprecedented events in terms of Brexit, in terms of Trump victory, and still the global markets have rallied pretty hard. In that context, how are you mapping up the global setup, and what this could mean for emerging markets like India?
Okay. I mean, I still consider Trump, as I said, a major risk factor.
Okay.
Obviously, the border tax, which we have heard a lot about, is a source of concern. But we are also saying on the other side, as I said, domestic fundamentals. And our view is what drives markets is actually ROE, or return on equity. And in our view, this is the best ROE fundamentals in 6 years. For 6 years, ROE in Asia-Pac has been coming down. And we're now seeing the first signs of what we call an inflection or a turning point. So we are kind of trying to advise investors that if we get a pullback because of Trump's policy, whether it's a border tax, a tariff, or protectionism, that also focus on the fact that it could be a buying opportunity, given that we are seeing this inflection point. And as an APEC strategist, I've been waiting for 6 years to see this inflection point. So we are highlighting best earnings growth since 2010, first pickup in ROE, since 2010. And the other real surprise has been this year we're starting the year with earnings upgrades.
Okay.
Again, that's the last time we saw that was 2010.
Okay. Even last time when I met you at this conference and we spoke about the markets and all, the one big thing that you had that in time was the global some sort of global commodity cycles and the commodity plays. I guess one of the big call last year for you in that model portfolio is Hindalco, and that's actually given 4x returns in the last 1 year itself. From a global commodities point of view, what's your view there? And you think there's still money to be made in some of the global commodity plays?
I mean, the commodity stocks have done very well. So, potentially going forward, the upside may not be as large as last year. So we have been a bit more kind of saying, buy the pullbacks, buy the dips rather than just buy the cyclicals. But our argument on commodities and the reason we like commodity stocks was not actually because of Trump. If you remember last year, my argument was that we're seeing supply cuts.
Correct.
So our argument has not been focused on demand rising. Our focus has always been that because of pollution and because of policy and because of, I guess, funding, China is actually kind of cutting back on supply.
Correct.
So we are still of that view. So we are again happy to be buyers of the dips.
Okay. So I guess that's been the big call from the whole Credit Suisse house, whether it's Nilkon, whether it's you. You all predicted the big slowdown in terms of supply from China, and that actually helped a lot of the commodity stocks. In fact, Nilkon tracks the commodity stocks very closely. He's been bang on as far as calls in the Indian commodity stocks. But the other interesting part of your report was that typically you've seen when Fed rate hikes, it actually helps emerging market in terms of sentiment and in terms of flows as well. We can just explain that rationale to us.
Okay. I think the question is you need to break up the Fed hike actually into what I call 3 phases actually.
Okay.
So going into the Fed hike is actually not positive for emerging markets.
Okay.
We tend to normally see a correction in markets going into the Fed hike, and if you recall, going into the first hike in December of 2015, we did get a correction. So the first part I always say it is kind of there is a correction, but we should buy the dip.
Okay.
Then there is a second phase when the Fed hikes, which is when we call it the real Fed funds rate is actually negative.
Okay.
So this is when policy is accommodative and becoming less accommodative.
Okay.
This is the period where I think is actually very good for emerging markets, and this is the period that we are currently in. Okay. So if you look at the real Fed funds rate today, it is about minus 0.5%. So we are still in negative rates. We still have policy that is accommodative. The part that is very negative for emerging markets is when the real Fed funds rate is above 2%. Depends on when we think we're getting towards restrictive policy. Okay. So as I said, we're still at minus 0.5%. So we still think there's
a lot of
upside.
room for
There's still
upside.
a room for markets to go up. Yeah.
Okay. What to your mind could be the key risk for emerging market equities in 2017? Because India's rallied pretty hard. Some of the emerging markets have rallied pretty hard in the last 2-3 months in the last few months. Broadly, what to your mind are the key risks that investors should watch out for?
I think the key risk still in the short term is still, with Trump now saying after healthcare hasn't done well, he's going to focus on tax. I still think the key risk, less over India, I guess, because India is more domestically driven, but some of the more export-driven markets like Korea and Taiwan, which we are overweight, that is still the key risk. And obviously, I guess, beyond November, after the politics, the Congress in China, then there's also a risk, I guess, on China. But at the moment, the Chinese numbers are looking good. So that's not so big a risk at this point. But that could obviously change as well down the track. So shorter term, we think it's actually not the Fed. Okay. Because the real Fed funds rate is still negative. So shorter term, we think the key risk is still Trump and any protectionist policies that come out as a result of that.
Okay. Shakti, I know in that 4 expensive basket, you classify the two baskets, the 4 cheap and the 4 expensive. And in that 4 expensive, India is probably at the top of the four countries that you identify. Still, you have got some exposure in the model portfolio of some of the cyclical Indian stocks. How much? So two-part question. How much downside risk do you see for the Indian equities, given that it's so expensive, and there is a risk of earnings not coming through? And how are you tactically positioned in terms of individual stocks in the model portfolio as far as India is concerned?
Okay. I mean, we are underweight India, so
Correct.
that means actually because we are constructive on markets, it's not that we think India is going to fall.
Okay.
Actually, our view is more that India is likely, we think, to rise by less than the overall
than the other markets.
Correct. So if you look at the expensive 4 basket, India has done well. But we look at the basket, and the other three markets, which are in the expensive four,
Correct.
Indonesia, Philippines, and Australia, have underperformed.
Correct.
So the basket as a whole has actually underperformed by around 3%.
Correct.
And the cheapest four, which is Korea, China, Hong Kong, and Singapore, has actually outperformed.
Okay.
So again, it's difficult to get every market right.
Sure, correct.
But our argument is that if you overweight the cheapest four and you underweight the expensive four, you have pretty much consistently added alpha over the time period.
Correct. I know within the cyclicals, you've tried to play, some of the IT stocks and the commodity stocks in India. Has that been pretty much the portfolio construction in the last 1 year, or have you looked to change a little bit after big rally, especially in commodity stocks in India?
Okay. I mean, in terms of the regional portfolio as well as in India, our focus has actually been on cyclicals.
Correct.
And within cyclicals, actually on tech and materials. That's been our two big overweights. The other sector that we also like is actually financials.
Okay.
So we also have a fairly big overweight within financials in the region.
Okay.
The only real big change, as I mentioned, that we have done over the last 3 to 4 months is to take a little bit of profit in the North Asian cyclicals and to add a bit of the ASEAN cyclicals. Yeah.
Right.
So not many changes beyond that, actually.
Okay. Well, you spoke about financials, and India has a very large share of financials in the index as well. And that's one big barometer of how the economy is performing. Anything that stands out within the Indian financials that probably you have in the model portfolio?
I think because our Credit Suisse team is still fairly cautious actually on the Indian financials. We actually do not have, we're not recommending, I guess, Indian financials. Okay. But we like financials in Korea, in China, even in Indonesia, Singapore, and so on.
So Sakthi, the one big call that I got from Neelkant last week was he's turned a little bullish on the Indian technology stocks. Okay. I know there are a couple of stocks that you hold in your model portfolio as well, but broadly from an Indian tech point of view, is there a view that you hold which probably is pretty much in line with what Neelkant's view is?
Yeah, I think we both feel that with the pullback in Indian IT, it looks interesting. Okay. But we are overweight tech, and it's not just Indian IT. We also like a lot of Korean tech stocks, Taiwan tech stocks as well. Okay. Which actually the problem is the other side. They've actually done so well that, as I said, we have been taking some profits in some of those names.
Sure. Last question before we wrap up, Sakthi. I asked you this question last year as well. What will make you bullish on India? I know you're not I know you're underweight India, but what will make you overweight India in the say medium to near term?
As I said, the reason for the underweight call is valuations. So if valuation's correct, we are happy to overweight. Okay. I mean, people forget that India was one of our biggest overweights.
Correct.
After the taper in 2013. Certainly was a big overweight. It was our biggest overweight market in 2014 prior to the election. And as I said, India, the ROE is picking up nicely. So the fundamentals are good. So it's just a question of valuation.
Relative valuations.
We like to have valuation support.
In fact, which is why I said in the intro as well, people really follow your advice very closely because you've been bang on in terms of calling the top and the bottom as far as Indian markets are concerned. So I guess that's why people are really happy to listen to you. Thank you very much, Sakthi, for joining us and giving your perspective. Thank you very much. Thank you.
Thank you.
Thank you.
With all this uncertainty one by one being out, and investors are getting used to the kind of the new, what you call it, the more populist kind of approach in the politics. I think everybody is adjusting to it, and then we'll eventually start focusing more on the value than instead of kind of the politics. But it's it's going to be part of the game, I think, going forward. Well, India for us has been always a very important country. I'm a big believer in the country. It has one of the largest and fastest growth globally, and definitely in Asia. I think we have seen growing faster than China, I think, which hasn't happened in a while, right? And I think the potential is immense. It's the second largest country in the world in the population. We are very active there. I'm very happy with the progress that we have made in India. We're very committed to the market, and I'm a big believer that there's a lot of big opportunities. You have a lot of global reaching companies that are Indian-owned, and I think that's great.